Hey, I know group accounting and corporate structure can seem more complex than they first appear. But don't worry, if you're a group accountant, a finance professional, or even if you're a student, this video is for you. In this video, we will explore when must a company consolidate another. The answer lies within one word: control. In this video, we can also understand the definition of control and significant influence as per IFRS, and we can also understand some key exceptions to the rule. So let's dive in. Now let's talk about what is group structure. A group structure is a formation or an arrangement of a group of companies. It is basically formed when one company directly or indirectly owns one or more companies. Now, what does it mean? When a company invests in another company, the accounting treatment depends upon the level of influence that it gains. If a company holds more than 50% of the ownership, then it is basically a control. If it holds between 20% to 50%, then it is a significant influence. And if the holding is less than 20%, then it neither be a control nor significant influence. This leads to different type of accounting. Control means the investee is your subsidiary and you need to account for as per IFRS 10 consolidation. Significant influence means the investee is your associate and you need to account for as per IAS 28 investment in associates. And if you neither have any control or significant influence, then it is your normal investments, and this needs to be accounted for as per IFRS 9 financial instruments. Now let's go deeper into the concept of control. Under IFRS 10, control isn't just about the percentage ownership, it's about substance. It's a combination of three things. Number one, power over investee. Number two, exposure to variable returns. And number three, the ability to affect returns. Now, what is power over investee? It is basically the current ability to direct the relevant activities. For example, deciding what products to sell or services to offer, setting and approving annual budgets and business strategies, making major investments or capital expenditure decisions. Secondly, exposure to variable returns. Your returns from your investees aren't fixed or guaranteed. They can be positive or negative. Think about profits and dividends, but also losses and liabilities. If you only received a fixed payment, regardless of the performance of your investee, you are not exposed to variable returns. And thirdly, the ability to affect returns. It's not enough to have power on papers. You must be able to use that power to impact your returns. For example, you appoint a new CEO to turn around the company. You change the pricing strategies to increase profit margins. However, the key is when all three of these elements are present, then you have a control over the investee. Now let's talk about significant influence. It is basically a power to participate in the operating and financial decisions of the companies, but not a power to control them. For example, you have a board representation, participation in the decision-making processes, having material transactions between the companies. The crucial is you have a voice, but you do not make a final decision. I hope you understand what is control and significant influence. Now let's talk about some complexities and exceptions to the rule. Ownership percentage, what we mentioned about, was just the starting point. The real life examples are much more messier. You might have more than 50% of the ownership, but you do not have control. How? It might be due to weak governance, contractual arrangements, or legal considerations. If we talk about weak governance, assume you own 55% of the ownership, but in important decisions need 75% of the approval. Now in this case, despite you are having 55% of the ownership, but you are unable to make decisions unilaterally. Contractual arrangements means an agreement between an investor and an investee that could override the ownership percentage, and legal consideration, such jurisdictional laws that may have an influence over how control needs to be assessed. On the other hand, there might be a case that if you own less than 50% of the ownership, but you have a control. Now this comes with a de facto control. This means that if a company in which you hold 40% of the ownership and all the remaining shareholders individually having a smaller percentage of the ownership. Now in this case, because you have the majority shareholding, you could be able to make a final decisions and then you can have a control. The other example is your potential voting right. Now assume if you have a 40% holding in one of the company and you also have an options which you can be able to exercise in the future, this will increases your percentage of holding from 40% to 60%. This means that you have a control now because your rights are basically substantive. If you found this video helpful, please like and subscribe to the channel. I am Saad from MHS Accountancy. Thank you for watching and see you in the next video.